We're also looking at Citi reiterating its S&P 500 year-end target as 5,100 this week. The firm noting earnings as a positive surprise, trending above average. This week we had Mohamed El-Erian, Lion's chief economic advisor. Here's what he had to say on what traders should be watching.
Earnings call. I listen really carefully to earnings call. You can start putting an image together by listening to different earnings calls and what they're telling you about what they are seeing. Companies are at the forefront, and they have a much better sense of what's going on the ground at turning points. And this could be a turning point. So listen carefully to what companies are telling us.
Well, we have the analyst behind that call, Scott Chronert, Citi Research head of U.S. equity strategy here. Good to see you. So obviously still seeing this frothiness in the market this morning with every bit of economic data that comes out. Walk us through this bullish call you have for the S&P hitting 5,100.
So, I mean, we've been bullish, going back to the middle part of last summer. It's been predicated essentially on gradually getting to a point where we get a changing Fed narrative and we move away from the hawkish dynamic of the past year or longer to something that's, let's call it, less restrictive. Now, at the same time, we've been arguing for some time this messaging on earnings resilience, that we felt that even in a mild recession scenario, S&P 500 fundamentals will hold up better than typically perceived. We've been getting that. And so we think that that mantra, constructive on fundamentals, even through an economic cycle, really underscores our more positive view.
Well, Scott, it's great to speak with you because we just got this University of Michigan sentiment data kind of adding to the inflation gloom just a touch, signaling that, the consumer is still concerned about the inflation picture. And that comes after a week of hotter than expected data. So I'm curious, to what extent do you think that the market is sort of mispricing this continued question mark in the room about whether or not the Fed actually has tackled inflation and they can start to discuss a pivot?
I think it's the million-dollar question right now. So you're spot on this. So the way we've been framing it is that we've had this strong rally, let's call it since the beginning of November, which is in response to 10-year yields coming down from 5 to as low as 3.8. What that has done is really increased a soft landing profile around the broader market setup. But what's happened is that move has come before we've actually seen a more defined earnings turn in many more cyclical parts of the market, including the consumer side. So essentially what we're suggesting here is that, is that 10-year nominals become your really important interest rate benchmark to keep an eye on, in our view, more so than Fed funds. We think we're going to get the Fed funds pivot eventually. But again, what we're arguing here is that equities are really going to respond to a lower 10-year nominal, which is what we're not getting courtesy of some of the macro data today.
And so when are you expecting to see perhaps a broadening of growth beyond the Mag 7 or the Fab 5, depending on whether or not you include Apple and Tesla in that? But when do we expect to see that broadening out, given how concentrated this rally has been in these tech names?
Well, we think it really sets up that we're going to begin to see it in some parts of the market, we think, as we go through Q1 and then into Q2. For many other areas, it's going to be second half driven. So the issue right now, again, we have a 5,100 target, doesn't look like much upside from where we are currently. Paint us constructive on equities and equity fundamentals, but we do have to acknowledge that we've had a lot of price action ahead of the fundamental follow through. That has us in a buy pullback mode, but it's, again, in the context of a more constructive view. From a sector perspective, we're going to see broadening this year. We're overweight tech, but we're also, from a barbelling perspective, overweight industrials, which we're quite constructive on structurally, and we've recently moved to an overweight on financials. In both of those cases, we're going to see, I think, the fundamental broadening effect begin to unfold in the first part of the year, really kick in the second half of the year.
Where can I be looking for evidence of more broadening, Scott? And honestly, let me change that question because I'm curious whether I need to even worry about the broadening. If I'm in the Magnificent Seven and I'm getting record-breaking highs every single day, why do I need to care?
Well, because I do think, well, there's a couple of elements to it. We're quite constructive on the mega cap growth cohort. Let's get that right. The fundamental dynamics here are uncanny in terms of the earnings growth and free cash flow generation coming from many of those companies. They do become more idiosyncratic in our view. Stop thinking of them as a group of 7-5. We think they're going to each begin to beat more to their own company-specific drummer, so we have to be attentive to that. The broadening effect, though, is really that it's, in our view, really difficult for the S&P 500 as an index to push materially higher just on the backs of this small cohort of companies. You want to see broadening into a more diverse array of companies, whether they're economic sensitive or perhaps even defensive, in our view, as a means of really creating a more structurally solid foundation for the S&P.
Scott, real quick before we let you go, what's more important, NVIDIA's earnings next week or continued Fed speak?
I think it's mostly Fed speak. I can't say it enough. We want to keep an eye on 10-year nominals. We're much more comfortable with the mega cap growth setup with 10-year yields closer to 4% than 4.5%.
All right, getting a fellow Fed fan here. Scott, thank you so much for joining us. We really appreciate your insights. That was Scott Chronert, Citi's research head of U.S. equity strategy, joining us on all things Fed and the magnificent 1, 2, 3, 4, 5. Pick your number there.